All right, let's get straight into it. This is a quick fire briefing on the first home scheme, designed to give you, as an advisor, everything you need to know: the mechanics, the rules, and the crucial warnings, so you can guide your clients with confidence. So, this is the big question that lands on your desk, right? Is this scheme actually a good fit? The whole point of this briefing is to give you the tools and the clarity to answer that question, not just for your client, but for yourself too. Okay, first things first, and this is probably the most critical concept to get across to your client. The first home scheme is not a loan. I'll say that again. It is not a loan. It's a shared equity partnership. The state isn't your client's lender. They're becoming a co-owner in the property. And here's what that actually means. The FHS puts in cash in exchange for a percentage stake in the home, the equity share. It is so important your client understands that this share is a percentage of the home's value. That means the actual euro amount they owe can and will change as the property market moves up or down. Let's look at a really typical scenario. Your client wants a 350,000 euros house. They've scraped together their 10% deposit, that's 35,000 euros. They've gone to the bank and gotten the maximum mortgage they can, 280,000 euros. But as you can see, they're still short. There's a 35,000 euro gap. Well, this is exactly where the first home scheme steps in. It plugs that hole with 35,000 euros, and in return, it takes a 10% ownership stake in the home. Simple as that. So before you even start crunching numbers, you've got to go through the eligibility checklist. These are the hard and fast rules, the non-negotiables. If your client doesn't tick these boxes, the conversation stops right here. On the client side, they have to be a first-time buyer or meet a few other specific criteria, like if they're coming out of a separation. They need mortgage approval from a lender who's actually part of the scheme. And this is a big one. They must be borrowing the absolute maximum the bank will give them, up to 4 times their income. They can't be using a mortgage exception, an MPE, to get a higher loan. And of course, they need to have their own 10% deposit ready to go. Now, it's not just about the client. The property itself has to qualify. We're talking about new builds, so houses or apartments in new developments. It also covers self-builds. And there's a very specific third category, a tenant buying the home they're renting, but only if the landlord has served them a notice to quit because they're selling. And remember, there are price caps on these properties, and they change depending on the local authority. You have to check the specific cap for your client's area. All right, let's get down to the brass tacks, the money. This is where your advice becomes absolutely essential for your client's long-term financial health. We need to talk about how much they can get, and just as importantly, what it's going to cost them down the line. And here we have a major fork in the road. It all depends on whether your client is also using the Help to Buy scheme. If they are, the first home scheme will only fund a maximum of 20% of the property's price. But if they're not using Help to Buy, that FHS contribution can go all the way up to 30%. This is a huge detail that will completely change your calculations. Now about those long-term costs. For the first 5 years, it's what you might call a honeymoon period. 0 charges. But, and this is a big but, from year 6 onwards, a service charge kicks in. And as you can see, that charge doesn't stay static. It actually climbs over time. This is a future cost that absolutely has to be factored into their affordability planning. You have got to hammer this point home with your clients. Paying this service charge does absolutely nothing to reduce the equity share they owe. It's not a repayment. Think of it like a maintenance fee on the account. The only way to actually reduce the percentage they owe is to make specific, separate payments to buy back the equity. Okay, this next part is maybe the most important concept for a client to wrap their head around: repaying the equity. Because it is not like chipping away at a normal loan. The final bill, the amount they have to pay back, is directly tied to what their home is worth in the future. So let's look at the scenario everyone hopes for, right? The property market does well, and the home's value goes up. The client got 35,000 euros from the scheme for that 10% share, but now with the house valued at 400,000 euros, that same 10% share will cost them 40,000 euros to buy back. The scheme shares in the profit. This is the key risk they need to understand. And of course, the coin has 2 sides. If the market dips and the property value falls, the opposite happens. The scheme shares in the loss. So that 10% share that was originally worth 40,000 euros now costs only 39,000 euros to redeem. While that might look like a discount on paper, let's be honest, it means your client is in negative equity, and that is not a situation anyone wants to be in. Finally, let's talk about the fine print. These aren't my opinions. These are the official warnings, straight from the scheme's own documentation, and highlighting these is a fundamental part of your duty of care as an advisor. This one is huge, and it's a direct quote from their guide. So what does it actually mean that the scheme isn't regulated by the central bank? Well, it means that many of the statutory protections your clients might be used to, things like the Consumer Protection Code, simply do not apply to this product. That's a massive detail they need to be aware of. Your clients also need to be crystal clear on what forces them to pay the whole thing back in one go. Some are obvious, if they sell the house or if it stops being their main home. But here's a potential trap for the future. If they ever want to switch their mortgage to a lender who isn't part of the scheme, that automatically triggers a full and immediate repayment of the equity share. That could really limit their options down the road. And look at this. This is the scheme's own advice, taken right from their official guides. They are literally telling people to seek out independent financial and legal advice. They're telling them to come to people like you. It just underscores how vital your role is in helping clients navigate this complexity. So there you have it, the First Home Scheme. Look, it can be a real game changer, an incredible tool for the right client in the right situation. But as you've seen, it's packed with unique conditions, long-term costs, and some serious fine print. Armed with this breakdown, you're now in a much better position to provide that essential independent advice. The only question left is, how will you use it to advise your next client?